Be Wealthy and Smart, episode 1032.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to ask, are we in a hyperinflationary depression? Because that's what's being talked about out there. That's what some people are saying. And I beg to differ. There's so many positives that are coming to light that are just around the corner. I'm super excited about what I'm seeing coming up here. Maybe not in the short term. It's hard to say where exactly things are going to bottom. But I would say later this month, things are going to start looking up dramatically. So first, let's talk about what is a hyperinflationary depression and why are we not in one? Well, first of all, a recession is 2 quarters of negative gross domestic product, GDP, back to back. We did have one negative quarter of GDP. Last quarter, GDP was down 1.4%, which was very surprising because it was a lot more than people expected. They were expecting a positive GDP. So this really caught a lot of people off guard. People weren't expecting it to be negative. So immediately when you print a negative GDP quarter, your mind jumps to, well, are we going to have a second quarter like that? Because if we are, then that is a recession. But here's why I don't think we are. First of all, the problem is not that we have too much demand, which is usually what's causing inflation, is too many dollars chasing too few goods. In our case, the problem is on the supply side, where the supply chain has shortages and interruptions and problems. Things are stuck in China. Things are stuck off the coast of California. There's things everywhere but where they should be. And these are shortages that are caused from dislocations, not from too much demand chasing too few goods. Secondly, we only have the 1 quarter of negative GDP, not 2. And I don't think we're going to get to 2 quarters of negative GDP. Why? Well, because of all those positive things on the horizon I told you about. First of all, I think COVID is getting better, so people are not going to be as ill. Yes, there is talk of a lockdown in China, but we are definitely not looking at lockdowns in the United States, in my opinion, and that is a completely different thing. Number 2, we only import 15% of our food, so most of our food is already here. And yes, I still think you should stock up and have a full pantry, but the reality is we only import 15% of our food. Number 3, it looks to me like there's a good chance that there's some sort of peace negotiation that's going to happen between Russia and Ukraine fairly soon. Number 4, the Federal Reserve meets today, and a lot of people are still expecting a 50 basis point or even a 75 basis point hike. Now, most of that comes from the last meeting that the Fed had and their talk or their jawboning, as I say, about raising interest rates, which makes interest rates go up just by their very discussion of that. Talking about the possibility of raising rates makes rates go up in anticipation that they will be raised in the future. However, since we had this negative GDP quarter come out of the blue and people weren't expecting it, the Fed did not talk about that scenario at their last meeting. And it's my opinion that they're smart enough to realize they don't want to throw the economy into a recession, which they would do if they raise interest rates 0.5% or 0.75%, because the housing market is already slowing down due to higher interest rates. Banks have laid off hundreds of mortgage loan officers because people aren't refinancing and aren't buying new homes, and there's not enough supply of homes. So the number of homes being purchased is way down. And with interest rates going up, well, that just took away people's appetite for getting a loan because now their payments are going to be higher and they can't afford as much house. So all of those things tended to slow down the housing market, which in turn slows down moving and remodeling and resales of houses, and as I said, refinancing of mortgages. All kinds of things are affected by that. Big ticket items. So should the Fed raise interest rates by 0.5 point or 0.75 point, that would be very bad for the economy. So it's my contention that the Fed will not choose to raise interest rates. From the beginning of the year, I said 125 basis point hike in the first half. We got our 0.25% rate hike. I think that's all we get in the first half of this year. So I think the Fed will say they're done. The market hasn't priced that in. That will cause interest rates to plummet, and that will be good for stocks, and it will be good for housing, and it will be good for the economy. And it will help get things back on track and get us back to a positive GDP again. So I don't think we will have 2 negative quarters together. I don't think we'll have a recession. I think the stock market will take off like crazy because interest rates will drop. People won't have expected that, so it will be a surprise. If we get peace in Russia and Ukraine, that will be a surprise that people weren't expecting. If we get lower COVID rates, that will be a surprise people weren't expecting. We have a lot of good news that's not priced into the market yet. And that, I think, will force the shorts, which many hedge funds are short right now. It's going to force a short covering rally where they're going to have to go out and buy stock and cover their short positions. So this is going to cause markets to go up sharply. And that's why I think we have a crash on the upside, because those shorts have unlimited losses on the upside. They borrow shares, sell them, and hope to buy them back lower and close the trade. When the stocks go up and it goes above the price that they borrowed the shares at, they're at a negative deficit. And that loss can continue as long as the stock goes up so that they have unlimited losses. This is financially devastating for investment firms that are net short, and there are many of them that are very short right now. So there's going to be a massive short covering rally, which is going to send stocks higher, particularly technology stocks, who are going to rally on the lower interest rate news, because they are impacted the most and most positively from lower interest rates. So I think there's so much positive news that isn't priced into the market, but all of the negative news is priced into the market. And that's why I don't think we're going to have a recession of 2 negative quarters back to back. I don't think we'll get that second negative GDP quarter. I also don't see that we'll have a depression at this time. Now, looking out a few years, I have my forecast about the housing market looking out a few years and some other things. And are we going to have trouble out in the future? A few years from now? Yes, we will, but it's not now. And that's where people are getting confused. This is what happened in the pandemic, too. When I said the stock market was going to go up, there weren't going to be numbers to compare it to. It was just going to rise from all the stimulus. And everybody else, it seemed like, had a forecast that we were going to have a crash, a depression, things were going to be terrible. I kept saying, no, it's not. The market's going to go up. And it's the same thing again today. I say the market's going to go up. Pretty much everybody else is saying, no, recession, depression, crash, whatever. Crash on the upside from stocks moving higher. And it won't be us that's crashing. It'll be the funds that are short that have unlimited losses that will be crashing. But the stocks will be going up. It's my contention that my cycle work is showing very positive indicators. The stocks are ready to not only move higher, but sharply higher by the end of May. The good news isn't priced in, but the bad news is. And if we have any more good news that I haven't mentioned, well, that's just going to be even more of a catalyst to send stocks sharply higher, which is what my work is telling me is going to happen. So stay positive, buy the dips, hold through this. There are better days ahead. And a few months from now, you're going to be very, very pleased that you sat through this and held on. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And all of my podcasts are available on my website at lindapjones.com/podcasts, where I have a whole wealth mentoring library of any topic you want to know more about. And while you're at my website, sign up for my weekly newsletter where I give you more tips, more insights, and what's going on in the market. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.